Imagine this. You've learned a strategy, watched a bunch of tutorials, maybe even back-tested a system. But the moment you sit in front of the charts with real money on the line, everything changes. Your heart beats faster, your palms get sweaty, and suddenly, all that knowledge disappears. You enter too early, exit too late, move your stop-loss, or double your position out of anger or fear. Later, you look back and think, why did I do that? I knew better. That gap between what you know you should do and what you actually do is trading psychology. In this video, we're going to build the foundation you actually need as a beginner trader. Not just strategies and indicators, but the mental skills to be disciplined, confident, and consistent. By the end, you'll understand why your emotions take over, how to regain control, and how to design simple habits that support you instead of sabotage you. Let's start with a hard truth. Most new traders don't fail because their strategy is terrible. They fail because they can't execute their strategy with discipline. They change rules mid-trade. They chase moves out of fear of missing out. They hold losers and cut winners. They trade emotionally, not logically. So what exactly is trading psychology? It's the set of thoughts, emotions, beliefs, and habits that show up every time you risk money in the market. It's how you react to losing, to winning, to being wrong, to being right, and to uncertainty. The market is a mirror, and it constantly reflects back your fears, your greed, your impatience, and your ego. You cannot remove emotion from trading. You're human. But you can learn to notice those emotions, manage them, and act according to your plan instead of your impulses. And that's the goal. To make this simple, let's break beginner trading psychology into three main pillars: discipline, confidence, and consistency. Think of these as three legs of a stool. If one is missing, the whole thing collapses. Let's talk about discipline first, because without it, nothing else matters. Discipline is your ability to follow your rules, even when you don't feel like it. It's what stops you from entering random trades because you're bored. It's what keeps you from moving your stop-loss just because you hope the price will come back. Discipline is not about being robotic. It's about being committed to your process. Most beginners say, "I'll be disciplined," but they never define exactly what they're supposed to be disciplined about. You can't follow rules you've never written down. So the first step toward discipline is to have a clear trading plan. A trading plan is simply a written description of how you trade. How you enter, how you exit, how you manage risk. What conditions must be present for you to even consider taking a trade? If your rules live only in your head, they are not real rules. They are suggestions, and in the heat of the moment, your emotions will rewrite them. Your plan does not need to be complicated. In fact, it should be as simple and specific as possible. For example, I only trade this specific setup on this time frame during these hours. I risk this much per trade. I close the platform after 3 consecutive losing trades. Specific, eager, measurable. Once you have written rules, discipline becomes easier. Now every decision can be tested against your plan. A simple question like, does this trade match my rules, can stop a lot of impulsive mistakes. Another powerful way to build discipline is to use a checklist before you enter a trade. Literally, walk through the conditions that must be present. If all conditions are not met, you don't trade. This not only slows you down, it moves your brain from emotional mode into logical, checklist mode. Of course, the moment you put real money at risk, your emotional brain wakes up. Fear and greed show up instantly. So let's talk about those, because they are the main enemies of discipline. Fear shows up as fear of losing, fear of missing out, or fear of being wrong. You might hesitate to enter a valid trade because you're scared of another loss. Or you might jump late into a move because you're terrified it will run without you. Or you may refuse to close a losing trade because that would mean admitting you were wrong. Greed, on the other hand, shows up as overtrading, oversized positions, or refusing to take profit when your plan says you should. You think, just a little more, and suddenly a winning trade turns into a loss. Here's the key insight. Fear and greed are not the problem by themselves. The problem is when they control your actions. when your behavior stops following your plan and starts following your feelings. The way to regain control is not to be stronger or have more willpower. It's to design your environment and your rules so that emotional decisions are harder to make. That means using hard stop losses instead of mental ones. It means deciding your position size before you enter the trade, not after. It means limiting your daily loss so you physically stop trading once you hit it. It means pre-committing to rules when you are calm so you don't have to negotiate with yourself in the heat of the moment. Over time, when you repeatedly follow your rules, something interesting happens. You start to build confidence. Confidence in trading is not a belief that you will win every trade. It's a belief that, over a series of trades, if you follow your edge, you will come out ahead or at least be in control. It's trust in your process, not in any single outcome. Most beginners try to build confidence the wrong way. They want a perfect strategy that never loses. They seek certainty from the market. They keep changing systems after a few losses, chasing the illusion of a holy grail. But trading is a game of probabilities. Even the best strategy has losing trades. What separates professionals from beginners is not the win rate alone. It's how they think about wins and losses. A professional expects losses, not because they like them, but because they understand that losses are the cost of doing business. Just like a store has costs for rent and inventory, a trader has costs in the form of losing trades. They don't attach their self-worth to each trade. They don't see a loss as proof that they are stupid or incapable. They see it as data. You can start rewiring how you think about losing by changing the question you ask yourself after each trade. Instead of, "Did I win or lose?" ask, "Did I follow my plan?" If you followed your rules and lost money, that's still a good trade. If you broke your rules and made money, that's a bad trade. This is how real confidence is built. Not by avoiding losses, but by consistently proving to yourself that you can execute your plan, no matter what happens on a single trade. One powerful tool for this is a trading journal. After each trade, write down why you took it, how you felt, whether you followed your rules, and what you can learn. With time, your journal will show you patterns in your behavior. Maybe you overtrade after a big win. Maybe you revenge trade after a big loss. Maybe you take low-quality trades when you're tired or distracted. Once you see the pattern, you can change it. Journaling is not just about performance tracking. It's about emotional awareness. It helps you bring your unconscious habits into the light. Let's talk about consistency, the third pillar. Consistency is not about having the same result every day. It's about showing up in the same way every day. Taking similar quality trades, sticking to similar risk management, following a repeatable process. Inconsistent traders constantly switch styles, time frames, indicators, and even markets. One week they're scalping, the next week they're swing trading. They hear about a new strategy on social media and abandon their old one before giving it a real chance. This constant switching keeps them stuck in the beginner loop. To become consistent, you need to simplify. Pick one market, one or two setups, one time frame, and one risk model. Commit to learning that deeply for a meaningful sample of trades. For example, you might commit to taking one specific setup for at least 50 to 100 trades before evaluating its performance. This gives you enough data to judge whether your edge is real and whether it suits your personality. Consistency also comes from routine. When you treat trading like a business, you don't just roll out of bed, open a chart, and start clicking buttons. You have a pre-market routine. You review key levels, check news, scan for your setups, and mentally prepare. Even a 5 or 10-minute ritual can make a big difference. When you sit down, you are signaling to your brain, "We are entering trading mode. We follow rules here." This can be as simple as reviewing your plan, reading your risk rules loudly, and reminding yourself, "My job is to make good decisions, not to force profits today." Now let's address some specific psychological traps that destroy discipline, confidence, and consistency. One major trap is overtrading. This is when you take far more trades than your strategy or your plan calls for, usually because you are bored, frustrated, or trying to make back losses quickly. Overtrading often leads to emotional burnout and big drawdowns. To combat overtrading, define your maximum number of trades per day or per session. Once you hit that number, you stop, no matter what. This creates a boundary that protects you from spiraling. Over time, you'll learn to be more selective, waiting patiently for high-quality setups instead of chasing every little move. Another big trap is revenge trading. You take a loss, feel angry or embarrassed, and immediately jump into a new trade just to get the money back. This is one of the fastest ways to blow up an account. The antidote is a cool-off rule. For example, after a large loss or after 3 losing trades in a row, you must step away for a set period, 15 minutes, 1 hour, or even the rest of the day. This gives your nervous system time to calm down so you don't make decisions purely from frustration. Then there's the fear of pulling the trigger. You see your setup, you know your rules, but you freeze. You watch the trade run without you and then you chase it late. This usually comes from either risking too much per trade or putting too much importance on each individual outcome. To fix this, first reduce your risk size. Trade smaller. So small that a loss barely matters emotionally. The goal early on is not to get rich. It's to build skill and confidence executing your plan. Think of it like paying tuition. You're buying experience with small losses. Second, remind yourself that no single trade determines your success as a trader. Your edge plays out over a large sample of trades, not 1 or 2. Your job is to execute the next trade correctly, not to predict the outcome. Let's talk about managing emotions in real time, during a trade. The moment you are in a position, you will feel your brain trying to take control away from your plan. You might stare at every tick of the price. You might feel urges to move your stop a little bit wider. You might feel relief when price moves in your favor and anxiety when it doesn't. One simple technique is to predefine your actions. Before you enter, decide 3 things: where you get out if you are wrong, where you take profit if you are right, and under what conditions you would move your stop or manage the position. Then, once you are in the trade, you don't negotiate. You simply follow what you already decided. Another technique is to physically step away from the screen after entering a trade, especially if you tend to micromanage every candle. You've already put your stop and target in. Watching every tick won't improve the outcome, but it will increase the chance that you interfere emotionally. Breathing can also help regulate your nervous system. When you feel your heart race, take a few slow, deep breaths. Inhale through your nose. Exhale slowly through your mouth. You're not trying to remove emotion completely. You're just trying to bring yourself back to a state where you can think clearly. Now, let's address expectations, because unrealistic expectations are at the root of a lot of psychological pain in trading. Many beginners secretly expect fast, large profits. They see stories of people turning small accounts into huge amounts in a short time, and they want the same. This leads to oversizing trades, taking bad setups, and treating trading like a lottery, not a business. You need to understand that professional traders focus on risk first, not profits. They think in terms of probabilities, risk to reward, and long-term edges. They know that their job is to survive first, then grow. A helpful mental model is to think like a casino. A casino doesn't care about one person winning at a table. They don't panic when someone hits a jackpot. Why? Because they know that over thousands of plays, their small edge will play out, and they will make money. They manage their risk so that no single outcome can destroy them. As a trader, your goal is the same. Develop an edge. Define your risk. Let the probabilities play out over many trades. In this mindset, a losing trade is just a normal part of the distribution, not a crisis. Another critical aspect of trading psychology is separating your identity from your results. You are not your last trade. You are not your account balance. When you tie your self-worth to your performance, every loss feels like a personal failure, and every win feels like validation of your value as a person. This emotional roller coaster will drain you. Instead, define your success by your behavior. Ask, did I act like the trader I want to become? Did I follow my process? Over time, if your behavior is consistently good, your results will follow. Now let's put everything together into a simple daily approach you can start using as a beginner. Before you trade, review your written plan. Remind yourself of your rules, your risk per trade, and your maximum daily loss or number of trades. Take a moment to check in with how you feel. Are you tired, stressed, or distracted? If so, consider trading smaller or not at all. No trade is also a valid decision. During your trading session, only take trades that clearly match your plan and your checklist. If it's not obvious, skip it. There will always be another opportunity. Enter with your stop and target in place. Once the trade is live, manage it according to your predefined rules, not your feelings. After you're done trading, journal your day. What trades did you take? Did they follow your plan? How did you feel before, during, and after? What did you do well? What can you improve tomorrow? This reflective practice is where true growth happens. As you repeat this cycle, something powerful will happen. Your brain will start to trust that you are serious, that you are not gambling, that you are learning. You'll experience less panic and more clarity. Your discipline will grow because you have structure. Your confidence will grow because you see yourself executing your plan. Your consistency will grow because you are no longer changing everything every day. Remember, trading psychology is not something you master overnight. It's something you build through repetition, self-awareness, and honest reflection. You will still make mistakes. You will still feel fear and greed. But with the right tools and habits, those emotions will no longer control you. As a beginner, your advantage is that you can build good habits early, before big money is on the line. Protect your capital. Protect your mindset. Focus on the process, not on quick profits. Discipline is doing what your plan says, not what your emotions say. Confidence is trusting your process, not expecting every trade to win. Consistency is showing up with the same standards every day, regardless of yesterday's result. If you commit to these 3 pillars, you will be miles ahead of most beginners. You'll trade less like a gambler and more like a professional risk manager. And over time, that mental edge will become just as important as any indicator, any pattern, or any strategy you ever learn.